We're going to go over for the next hour, like an hour and 20 minutes, over some important accounting updates that are happening that affects everybody here in the room. I'm going to just move this because I have my own mic. Good. So we have up today, as Warren said, Mike McNee, the partner in charge of our not-for-profit group, and also the partner in charge of all of our test function. And I am a director, as Warren said, in the professional standards group. And yes, I worked with Rick Hole in my past. That was an interesting part of my career. And now I do quality control for the not-for-profit group here at Mark Spaneth.
So I just want to chime in. A lot of you who do know me know that I don't hold back. I'm not shy. John's going to get plenty of time to talk today, but he's a little worried he won't get enough time, but he's going to promise him. If Sibby's out there in the ether on the web, I hope you're tweeting away because I know you're a big tweeter. We're going to miss that, and we miss you today, but he'll be fine. He's just took ill this morning. I also want to just make some comments about Jim Sheehan, who I view as a personal friend. I'm sure Jim left already. He and I have spoken together a number of times, and not only do I love his war stories, but I love the passion he has for the industry. And I think it's the same passion that everybody here in this room has, whether you're on a board, whether you're a CEO, CFO, whether you're a staff accountant, whatever brings you here today besides breakfast. I would say that the passion is always there, and I agree with Jim completely. I mean, there's always rogue, and we see that all the time, but the reality of it is 98% of you are all of the charities that we deal with are fabulous. And I just wanted to thank you all for being here today and being part of this learning experience. And I want to thank Jim. He's gone already, but he's a great guy. And the resources that the Charities Bureau has, they change them all the time. So if you're on that 3,000 member, whatever we call it, a VIP email list, you're getting it. You see what the updates are. If you're not, get on it and get those emails because they do stream in. So sorry for the interruption.
Good. Okay. So we have three important topics that are happening in the accounting world that we're going to go over today. There are others out there, but we felt that we'll limit it to these three. And the first one is the big one that is going to change how your financial reporting is going to be done going forward. As of 12/31/18 and going forward, your financial statements are going to definitely look different than how they looked in the past. I'm going to go over that thoroughly. That's again really happening soon. There's a new accounting standard update that came out during the summer on how contributions are going to be considered, and it affects how government grants are actually going to be recorded. I would think a lot of you folks here today will have some kind of government grant. This changes how government grants will be kind of considered and recorded. So we're going to go over that thoroughly, and then we're going to end up with leases, which is another big accounting standard that's happening in the next year or two. So that's what we're going to go over today. But of course, if you have any questions on any other kind of accounting stuff, we're open to a lot of different things also.
So John, these ASUs, the numbers that they go by are the year they were issued and what number ASU
Yes.
for the year. So we can see the lease standard, which is the last one we're going to talk about, which is still, I think, the furthest one away technically. That one, we've probably been talking about this, and you all have been talking about this for probably 7, 8, 10 years. It's a long, long time coming. The other ones I think were fast-tracked a little bit more, and the middle one that's there, the one that was issued in 2018, that's actually, I like to refer to that one as a patch. And what I mean by a patch is when the FASB was first wrestling with revenue recognition because they wanted homogeneity amongst all companies, not-for-profits, for-profits, but it's always hard to figure out not-for-profits for some reason. But in particular, in the for-profit world, they wanted more uniformity on the rev rec. So it became a big deal, a lot of talk about it for a number of years. And what they did is the FASB did something very appropriate. They scoped out in that middle one there, they scoped out contributions. They said, you know what? Recognize contributions the way you've always been doing it. If they're temporary restricted, or we'll talk about some of the new terminology in a minute, or they're unrestricted, or what have you, or you're picking them up because they're either, because they're not conditional, or you're disclosing them because they're conditional. Whatever the categories were, we're going to leave you alone. They forgot about a little thing. They forgot about government grants. And government grants, I think, for many of the people in this room, is kind of a big deal. So without having addressed government grant revenue recognition, they would have left a fairly large question in people's minds who have to deal with this kind of stuff every day as to how to really record revenue. So that patch that they issued in 2018 effectively addresses specifically that issue. And we're going to spend a lot of time on that, probably most of the time on the financial statement issue, but because it's upcoming, you're all thinking about it, especially in terms of comparative financials that are coming up and all that. But I would say that this middle one, even though some of the stuff on the slides, we're not going to hit every slide. I mean, please don't write down and complain that we didn't talk about every slide, because we're not going to do that. But I think that when we do get to those slides, you're going to see that there's some pretty important thinking that has to be done about how one recognizes revenue. I can tell you from the number of people that I know in this room and the kinds of funding that you have, probably when the day is done, it's not going to be that big of a deal on the government grant side, but there are going to be some that will be affected. So I'll let you get past slide 3.
Okay, good. We're moving right along. Okay, well, as Mike said, we're going to start on one of the biggest ones that's happening now for calendar year 12/31. If you're at 12/31/18, you'll have to adopt these new accounting standards. So let's go right into it. As you can see, some of the objectives, when they wrote this back in 2016, FASB wrote it saying that there's a time for a change on how not-for-profits need to report their financial information. They felt that it needed an update. They kept calling it not an overhaul, but in my opinion, it was a little bit of an overhaul, but they wanted to sell it as an update. All right, so they want to update the current model, which we've been using since the mid-1990s when FAS 117 came out. We've been using that since then, and it was definitely time for a change. So the couple of things, the objective was to improve the net asset classification, approve more information. They want a little bit more information on liquidity, expenses, cash flow statements, management in general. There's a whole load of other concepts in 2016-14 that now we would have to come with. And a lot of it, in my opinion, was for consistency. In the past, when FAS 117 was written, it was a lot for flexibility, because there's so many various different not-for-profits out there. In my opinion, it seems like FASB wants a little bit more consistent financial reporting, and that's what, in my opinion, this is how this came about 2016-14. And of course, their goal was the objective that you yourselves tell your financial story better through your financial statements, which is a very important kind of concept. I think all non-for-profits should be doing that better so then the world knows the good that you're doing. Okay?
So John, is there anybody here from FASB in the audience? How about AICPA?
Good.
No hands up? Okay. So I can speak freely. These are my own opinions.
I was going to do that anyway. No.
These are my own opinions. They're not Mark's Panis opinions, but I think some of you may share some of these. Just to give you a little bit of humanistic approach to this, John and I, when the exposure draft first came out on this prior to August 18/16, I think the FASB did a very nice job of really sending it out to people, looking for comments, coming back. Our firm had a pretty sizable commentary on the exposure draft on this. And we were asked to actually come up to Connecticut, John and I sat in front of I think there was 6 FASB board members there that day, and the technical staff. Some of you may know Jeff Mechanic is a great guy, Rick Cole, just in case they're on the webinar. Great people. They really are. I truly mean that. But the discourse that took place it was a morning session and an afternoon session, one on the East Coast, one on the West Coast, with national firms like Mark's Panis, national charities, a lot of interested parties in terms of what this was going to do for them or not do for them. State societies, et cetera, et cetera. And these were all people who had written their white papers in terms of their commentary. So when we got up there, I will say that they basically kept most of the stuff that they were talking about intact. One of the items that I will get to, and I'm going to hammer on it, is I don't know that the liquidity disclosure, that's why I asked him from FASB's here, I'm not sure that I think the liquidity disclosures are all that great. I think what you'll see in there when we get to that slide is, yeah, okay, I see what's there, but it doesn't really tell the whole picture. And we're going to talk to that when we get to that slide. I think that was one of the biggest takeaways that we had from there, because many of you have in your current unrestricted net asset class property, plant, and equipment, right? That's one big thing. So it's embedded in your unrestricted net asset class. It's still going to be embedded in the net asset class without restrictions, just a different name. So by the FASB not addressing the issue of peeling that away and requiring the net investment in PP&E, net of any associated mortgages or loans, be broken away within that without restriction column, I think it was a mistake. I really do, because I've seen a lot of agencies. We all know the FEG stories and other places that had some real troubling times. When you look at their balance sheet and you actually extract out what's going on, you peel away the onion, the emperor's new clothes, so to speak, you really see a lot of stuff that's going on that doesn't make the place look too healthy. This is a pretty decent job of coming to a better representation of liquidity and the health of the organization. I don't think it goes far enough. I really don't. Just my opinion. Sorry, Rick, if you're up there.
Good. We proposed that, Mike, about the breaking out the PP&E, and they didn't go with it. So
Right.
that's fine. All right. Here's the key provisions, as you can see on your slides and in your material, if you have them in front of you. These are the main things that ASU 2016 wanted to address in the financial statements for not-for-profits. The first being that net asset classification, simply because the words unrestricted, temporary restricted, and permanently restricted are not really 100% true anymore because of different laws and different things. You know, unrestricted isn't really unrestricted. It might be without donor restrictions, that's what the new term is going to be, but it might be restricted for legal restrictions, internal restrictions. So that word unrestricted wasn't really good enough. So that's why they wanted to change it. And the same with permanently restricted. Permanently restricted, is it really permanently restricted if now in New York, NIPMIFR is allowing you have an endowment that would be spent from that? So those words needed changing. So that was one of the key things that how this came about, this 2016-14, was to change that terminology. So there's no misnomers out there. So now the new classifications, as we're going to go over on the next slide, will be with donor restrictions and without donor restrictions. That is very clear. You have with donor restrictions and without. Doesn't mean there might be other restrictions, but it's at least without a donor restriction. That is a key change in what they really wanted to address in this ASU.
Well, I also think that they wanted to avoid, because we're talking about thousands and thousands and thousands of charities across the United States who you might guess might report some things a little bit differently. So there was a lot of, I think, folks, especially audit firms, that might not do so many charitable audits, that were not familiar with the rules surrounding board designated funds, and they wanted to make sure that it was very clear to not have board designated somehow appear within a temporary restricted category, because what the board taketh away, the board can give back, and vice versa. So we all know that.
The other areas are almost equally important. Is the first one is that liquidity and availability. That's going to be a new footnote, new disclosures for not-for-profits on their liquid assets, their financial assets that are going to be available for the next year. We're going to go over each one of these in the next couple of slides. The other big area is expenses. As you know now, not-for-profits need to report their expenses by function. They always reported it by function. If they did report by natural classification, they at least needed a footnote saying how it's functionalized. That is going to change. They're requiring now not-for-profits are going to have to report by natural classification. That's your salaries, your rent, your depreciation, your interest expense in one place. Not all not-for-profits do that. There's a lot of not-for-profits that don't require that have to be done, but now it will be done. And it has to be in one place in the financial statements, by nature and by function. Okay. The investment return, again, in my opinion, FASB changed the requirements for investment return for consistency. Some not-for-profits were recording investment return net of the investment expenses. Some weren't. There's some not-for-profits that had investment expenses that were internal, that doesn't show up anywhere. So they changed it. We'll go over that in the next couple of slides. And there was a lot of debate over cash flow statements. They were in the proposed ASU, they wanted not-for-profits to report their cash flow by the direct method. Most probably do not. And Mike, and I think you
Yeah, I would say show of hands who uses the direct method of presenting their cash flows
Does anybody?
for external purposes.
It's indirect and direct. You just start off with the net asset class, or you just start off with your cash received. Usually, it's start off with your net asset changes, right?
So academia would say generally that the direct method is much more informative, especially for board members. But for simplicity's sake, I think the indirect method is kind of taken over. Anybody who has HUD knows that HUD requires that the direct method be used. So that's the only time that I'm aware that there's a stipulation that has to be used. So in my experience, and we handle about 150 charities of all ranges of size, I don't think we have any, frankly, that I'm aware of that are using the direct method, although it is, I think, pretty meaningful. And board members like it, but it's not required, so I think we're going to see status quo on that one.
I like the indirect method, so I'm good with that. That's how I learned it, and I thought it was useful also. And the good thing is they're not requiring any change. You can still choose between the indirect and direct method.
John, it's so funny because I do a lot of presentations in front of boards for post-audit results. I think I probably spend about a minute on the cash flow statement. And if you have different audit firms, maybe that's the same truth with you. Unless, of course, the organization is troubled financially or there's some real wide swing in the operational surplus that's coming from for the cash flows. You focus on those kinds of things. But if it's pretty much standard stuff, especially on a comparative, you blow by the cash flow statement in a matter of a minute, which I'm not sure that's fair.
Good. I agree. Okay, let's continue. Let's go over, like I said, we're going to go over each one of these individually. You've got a couple of slides on them. There's the net asset class. There's the current unrestricted on the top row there, unrestricted, temporary, and permanent restricted. That's going to be replaced with those just two categories, with donor and without donor restrictions. They can be, that means your temporary and permanent will be combined as, in one category with donor restrictions, like on the face. But it doesn't mean in your footnotes you still could break that out and know what those components of the with and without donor restrictions are. We have slides on those, all right? As it says there, we can disaggregate those further, that's fine, but at least it has to have totals of that. Each statement of activities and your statement of financial position or your balance sheet would have to have it by totals with donor restriction and without donor restrictions.
So one thing I'm going to say throughout the presentation, I'm going to keep hammering away at it until you get bored of me, is this stuff is now. It's calendar 18,
yes,
and it's fiscal 19. So we've been talking to our clients for years about this stuff, and as you get to the prior year before the required implementation, you have to think about what impact these things are going to have on your financial statement. So for many of you, you might be fiscal June 30, 18s. So while it's not required yet for another year for you folks, you really do need to think about what it's going to look like and what you want to do for comparative purpose. You've got to be ready. For calendar 18, you're there. I mean, you're just a couple months away. So you have to have this stuff really, really down pat by that point in time. And I would suggest there's nothing wrong with talking to your audit firm. As you know, their independence is not impaired by providing professional feedback on these matters. Can't make decisions. That's where our independence does get impaired. But certainly have that dialogue. It's good dialogue to have.
One other area within the net asset class was they wanted, again, for consistency purposes, of how if you have an endowment fund and the endowment fund was, for some reason went underwater, meaning that the value of the fund is now lower than what the historic value was. So they're revising how that's going to be classified. As you can see there on your slide there, currently it was classified with net assets without donor restrictions, and now it would be required that if you have an underwater endowment, that's an endowment that the historic value or the value that you're supposed to maintain in that fund is lower because of market conditions or something that brought it under, like after 2009 and 2010 when the market did really bad, there was a lot of endowment funds where the value was much lower than what it was, or their spending policies were higher than what they were earning and resulted in a negative endowment fund for that particular fund. And if you have multiple funds within your endowment, you would have to disclose, you would be an enhanced disclosure if you have now an endowment fund that is underwater. Okay, that's the only thing. That's again for consistency.
So again, I know John talked about this before, but I want to reiterate that this is a pretty key item in here, and what this does, amongst many other things, is what John touched on, but I want to just emphasize it. There was always a disconnect between the legal and the accounting. And this lines up the legal and accounting much better, because as John said earlier, you know, the legal has some different rules with respect to what state you're operating in here, and you know, here we have MIFA rules and so on and so forth. And the GAAP rules were a little bit different. So the lawyers would sometimes look at this stuff and say, well, law is law, I don't care what this GAAP stuff is. So that's what they lined up there. One of the other things I want to do is just go back to slide 7 for 1 second. I failed to mention this. You see down here this new disclosure requirement. You put a note in there. You might scratch your head and say, is that really new? Well, it kind of is. And why I say kind of is because if you had board designations associated with endowment funds, that was always a required disclosure under current standards to talk about that. And you see those wonderful notes where you show the board appropriations and all the rest of that stuff. So that was always there. This one now, because of the new standard, wants to know much more about board designation. So in the past, the FASB recognized that financial statements didn't say a lot about board designation. Sometimes they didn't even mention it, even though it was
required.
Right, even though it was in the unrestricted. Now again, I take the board. It's without donor restrictions. I get it, but now you have to show much more about that. So when you go back to your shops, so to speak to everybody and say, listen, let's look at what our board designations are. Let's revisit them. And let's make sure that we affirm them through board action. I think that's probably a good idea.
Great idea. Right.
Okay.
And now, if not, this is what Mike is saying. It's not just for a board-designated endowment. If the board designated money for a new capital project, that would have to be disclosed. You can't not have that and not be on your financial statements, on the face or in the notes, that within the unrestricted or now without donor restrictions, that there are donor-imposed. Not donor-imposed, board-designated imposed restrictions on that money, so it's not available. That was the whole idea of how FASB wanted have that disclosure. So right now, if you have board-designated money for a new capital project, that is not required to be disclosed, but it will be under this new ASU. Good. Let's continue. We talked about our underwater endowment. Here's an example of what your balance sheet, your statement financial position, could look like. These were examples that were literally right out of the FASB accounting standard update or an AICPA update. I mean, the minimal one is there on the top there. You're going to have your net assets without and with, and your total net assets. That is required on your balance sheet. But the bottom one there, I don't know if you can all see that from where you are, but it breaks out without your donor restrictions of what's really available for undesignated. It could be really used. It could what your operating reserve, if you have one, is, and your board designated by the board for capital projects. Right there, that kind of right there on the bottom, in the middle of that slide. That's going to be required. And then even with your donor restrictions, what has a time restriction, a purpose restriction, or the endowment fund. This is a nice approach because you're really telling the world right on your balance sheet where your net assets are comprised of.
And again, I would reiterate that for organizations that might be quite marginal in terms of their fiscal stability, if they have big investments in property, plant, and equipment shown on a cost basis and some related debt, you net the two out, and that's a big number. And that big number is actually going to be sitting up in here right, without donor restrictions. And same thing, it's going to be in undesignated over here. And I think, when you have an organization that's like that and you do that math, you end up sometimes, we've seen places where that number was a nice positive looking number, and when you do that math, it ended up being negative. And we can't insist, as your audit firm, that you do certain things because the financials are yours, right? So we do strongly suggest, for purposes of, especially it'll come up in the liquidity disclosure, that somehow be brought across to the public when you're in that scenario, okay?
Again, that's to help better tell your financial story. You have, let's say in this case, $125,000 of net assets without donor restriction. But imagine your building is on your books for $100,000. The net value of the building, that would result in you only have really 25,000 kind of, really available. Most of that net assets is tied up in your bricks and mortar. So that's a better way of telling your story, and that's what.
Or maybe not so for some in the room. I
Well,
don't know.
well, but then hopefully you can raise more funds that way. So we really don't have money to operate.
Anyway it shakes out, it'll come up in the liquidity disclosure.
Right. All right. Let's continue. Let me take that off of there. Good. All right. As Mike and I mentioned, board designated net assets need to be disclosed. The purpose, either on the face of the financial statements, as you can see on that one, or in a footnote describing it. As it says there, it's not required except for the board designated endowment. Right now, board designated endowments are required to be disclosed, but not for other purposes. Right. This is an interesting little known kind of thing in the accounting that was allowed, but it's not going to no longer be allowed. It's where not-for-profits got gifts of long-lived assets, buildings, or even something that could last for a long time. This was prior to this ASU. It was allowed that the non-for-profit can apply a time restriction. That ability to apply a time restriction to a building is no longer allowed. Again, for consistency. So some non-for-profits did it, and some non-for-profits didn't do it. Usually, this was written, I believe, back for the colleges and universities that would get buildings for them to use, and it was a gift. And in the year they got them, it would be a very big increase in their unrestricted net assets. But in the next 2 to, let's say, 40 years, when they had to depreciate that building, it would be a big negative in their unrestricted net assets. And I think way back then, this was early in my career when this probably was issued, that they were allowed, that FASB allowed them to employ that time restriction. They literally, book the building as temporary, and then release it as you incur the depreciation expense, and then the unrestricted column would be unaffected in year 2 to, let's say, 40 or year 50. That whole thing that was allowed has been taken away. So if you have a building that's on your books that's sitting in your temporary because you employed a time restriction, you would have to actually release all of it when this is in effect as of next year.
Yeah, so for the old standard, it's really a smoothing effect. That's what it was. Anybody who did that kind of an implementation was just smoothing things out, which is not a bad thing. Under the new one, it kind of follows the FASB's approach. You get it, take it into income, and you've released the restriction as soon as you place it in service.
Right, as it says there, once placed in service, it's there. That means in year 1, you'll have a large increase in your net assets without donor restrictions. Let's say if the donor didn't say you can, restrict the building for a certain purpose. Here's the building, use it as you want. That's an unrestricted gift. But if they said you can only use it for this and this purpose, then it might be, then it could be considered with donor restrictions. And that's fine. And then it will be released into unrestricted as you're using it over the life of the asset. But if it's purely an unrestricted kind of gift, you would have to be into unrestricted or now without donor restrictions. Okay. It's a little known thing. Here's one of the bigger things, liquidity and availability of resources. This is one of the more major impacts of this ASU that's going to affect not-for-profits. Well, they'll have to have additional disclosures, qualitative and quantitative disclosures on how they manage their liquidity, what their liquid resources are, and of that nature, so that the world can see how liquid and illiquid you are. And in my opinion on this is only not-for-profits. There's no other organizations out there. This is not for profits. It's not for any other. So for some reason, FASB felt that non-for-profits need to have this information in there.
Well, I think, in the public world, MD&A's, management discussion analysis, would theoretically touch upon these kinds of things. So I get what you're saying. It's not quite that prescribed, but the MD&A, which is management's attachment to the financials, should get to that. Let me just speak to this very quickly because I want to make sure we move along here. But on a personal level, again, I think that the FASB's intent was to ensure that there was just better transparency amongst not-for-profits across the nation, so that the reader could understand better whether they were contributing money or whatever their reason was for being interested in not-for-profit, what the heck was going on. And so, on the quantitative side, the one on the bottom in here, you're going to see an example of that. There's examples all over the place. You can get them from the University of Chicago. John Kroll's a friend of mine. I think he's the first guy, the first place I ever saw to implement early the standards at the University of Chicago. He did it like 3 years ago or something. And he's got some interesting ideas about how to present financial statements. And his audit firm, I think, is KPMG possibly, but or PwC, I don't remember. But they signed off, and it was fine. There's different ways to do a number of these different things. What I'm unhappy about with personally on the liquidity side of this thing, the example here is slightly modified from what you can see on the AICPA's or FASB's websites or other web-based information. We did it on purpose that way. But what I'm not really all that happy with is it doesn't tell you all that much. All it does, I mean, it's up here, it's not pulling in any liabilities. It's listing assets. Okay, I get it. Cash, that's free of any encumbrances, shows up here. Accounts receivable, again, free and clear. You're going to collect it, hopefully. That's hopefully after bad debt allowance. Operating investments, great, not otherwise encumbered. Promises to give, again, not encumbered in some way. If you have a promise to give that's attached to a restriction, that would never show up there because it's not liquid. You got to spend it on something, dollar for dollar, I'm assuming.
Or for any long-term purpose.
Yeah, and then the only thing on here that you won't find on the balance sheet is this thing. And if you have an endowment fund at your organization and you have a spending policy, in this case, I think the example is 4.5%, this is picking up next year's 4.5%. So sure, it shows you liquid assets, but it doesn't tell much about the bottom line stuff. And that's where we get into the qualitative. And the qualitative, in this example, I don't think is extraordinarily helpful. I really don't, because it waits until the very last sentence down here to talk about working capital. And working capital, most of us know what that means, but not everybody knows what it means. So it should be, I think, further defined how they came up with that, what's in there, so on and so forth. But we can see from this, $19 million of working capital compared to these liquid assets over here. It's a big difference, isn't it? Huge difference. So I'm not so sure just how meaningful this really is. I think they made an attempt to try to do it. Don't know that they got there. I don't think there's much else to say on this slide.
Good. Okay. Mike has a good point. It's just only one-sided. The liquidity and availability is how is that money available to pay current operations? It's really, it's just one part of it.
Actually, I do have one other thing I want to talk about. So in this paragraph right here, for those on the web, it's going to be the third paragraph from the bottom of the slide. It speaks to amounts available for general use. And I wrote a note to myself on that because this was an interesting thing that I think Mark's Paneth went through with a number of our clients for our calendar 17 audits. 17 for those agencies that had fairly sizable investment portfolios, booming year, just like everybody's 403Bs or whatever you have, 401Ks, great year. What happens in here is the general use of the earnings is further impounded. That word doesn't come up anywhere in standards, but it's further impounded by New York law, NIPMIFA, which says, by the way, you got to take those earnings that are not otherwise appropriated by the board, that aren't somehow restricted by the donor, and guess what you got to do with them? You got to stick them in the old temporarily restricted fund, and now you got to stick them in the similar fund with donor restrictions, even though the donor in this case has not made that restriction. It's by law. So it's really, it's kind of a quasi account, but that hasn't changed. And one thing I want to just give you is a thought, and I've talked to some of my clients about this. I think it's a good one. What I found from 2017 is that piece that was not appropriated grew dramatically. And we saw either they forgot to appropriate the board, or it was not enough. Let's say they had a 4%, whatever it was, and the number built up because the return on investments was 8, 9%, whatever it was. That temporary restricted built up dramatically with a row in the disclosure called, unappropriated earnings from the endowment from the, permanent restricted fund. I think what I've told some of my clients, and they've done some of this, is to have perhaps a durable type of a policy. So you don't have to revisit this. You don't have to remember to tell the board to do a resolution each year to do something. And the durable would be to perhaps have a policy that allows you to spend up to the level of prudence as determined by New York law, which is that 7% number we've heard about, either that amount or the actual spending policy. But somehow keeping that in mind, when those numbers go up, what you want to do is you want to grab those numbers that are being impounded into that restricted category, you want to get them out of there. You don't want to have to come back later on when you really need the money and have to, say to the Attorney General, oh, I need to spend more than 7% and here's why. Now, how often is that going to happen? I don't know, but it's just something to think about. So get as much, in my opinion, get as much out of that with restriction area of the unappropriated board earnings and do it in a durable way. So it allows you to just get it out of there and get it to the unrestricted.
Great advice, Mike. Very good. All right, let's continue. The next area is on expense reporting. Like I said earlier, currently, all not-for-profits report by function. That's by their program, management general, and fundraising. Now that analysis and the expenses will need to be reported by natural classification, which is not such a big deal because you need to do that for your 990 also. So your 990 reports your rent and your salaries and your depreciation and the insurance. You would have to actually show that in one place now. That's the key word there. One place in your financials. It could be right on the statement of activities, which would kind of be a little bit hard because it would be cumbersome, but it could be in a separate statement, a statement of functional expenses. I would think a lot of the not-for-profits here probably would have a statement of functional expenses. Then you're fine. Then this is no impact to you whatsoever. You're already doing what's required. If your statement of activities just list out program expense, management general and fundraising, and no breakout of that, then you would have to add that statement or have a footnote showing what your functional expenses, what your natural classification expenses really are. All right.
So the difference between the 990 though and this new matrix, as people call it, I think the one key thing is to think about how you disaggregate your program services. On the 990, you got just one column, and then on the next page, I think you show the P&L for each program you operate, which is never discernible from the financials. It's not actually highly meaningful if you ask me. But with that said, the 990 is all well and good, but be careful. Don't necessarily follow that model because it does certain things. I'm not sure it really necessarily tells the true natural expense category story. There's a lot of stuff that falls into miscellaneous on that statement. You don't want to have a matrix that's got 30 line items. But again, as an example, maybe you might want to consider on this line having salaries as a row and then benefits and taxes as another row, so people can see very clearly that you're running a 25% fringe and payroll tax rate, and then you have a subtotal which is pretty common, so you can see what the quote-unquote personnel services costs are. And then looking at other things, I mean, God forbid an organization grants to other organizations, which is this type of example. God forbid there be something in here in the management in general on something like that. But I think that would speak to some Jim Sheehan type topics. But in any event, one thing I wanted to point out on this, and this is a nice looking kind of a schedule of matrix that probably many of you are very accustomed to as a statement that comes just after the statement of activities. Some of you may have it in your supplemental. You can't do supplemental anymore. The auditors, nobody can sign off on supplemental schedule. This has to be either embedded as a statement that stands on its own or in the notes. Yeah. One way or the other. The main financials. But one thing I want to talk about is now is the time to re-examine your allocation methodology. We're going to come up to that in a minute because that's another. The key takeaways from this new standards is allocation methodology disclosure and liquidity disclosure. And I will tell you that on this one here, for instance, on interest, John and I were talking this morning because I thought about this on my train ride down this morning. I said, a lot of places don't want to load up on management and general expenses if they don't have to, right? Because you want to look good to the public. I don't know that anybody who's spending 98% on program is really telling the truth, but that's besides the point. So there is definitely there's a bell curve in there that we look for. So assuming it's 10% is your management in general, if you wanted to get that down on the interest expense would be a good example. You'd want a specific identification on the interest expense. So if you have programs that are cash flow draws and are pulling away from you, allocate your line of credit interest expense there. Don't dump it in management in general, which is oftentimes the default position.
Perfectly allowed to do.
Charities take. So, or obviously if you have mortgages or other loans that are specific to each program.
Got a question, Mike? Go ahead, sir.
I know I may be a slide or two ahead, but where would you show investment expenses on that, for example, that sample statement of functional expenses?
They're now netted. They're now netted.
It could be.
The investment expenses, are you talking about in-house investment people, or are you talking about broker fees or whatever?
Investment management expense.
Yeah,
Outside firm.
yeah. So those are now basically netted against the income. If you wanted to show it and have it in here, you could do all sorts of things. You could have a subtotal with it in there, and then take it out, just the way a lot of people do with direct fundraising costs, and then come back to the net, which would tie your number back to the statement of activities. I still remember your name, Gary.
Very
Okay,
good.
so give it some time, give it some thought. Now's the time to examine your allocation methodologies. I'm not lobbying for doing anything inappropriate. I'm lobbying for reality. And I think a lot of people have kind of gone by what they've been doing all along, and it's analytically reasonable, and so on. So take another look. Now's the time.
Yes. Well, going back, I skipped ahead, and I want to go back one slide. For you guys that are following along, we skipped over that because I wanted to show the example first.
Okay.
But as Mike is saying, the allocation methods are important for you to be looking and revisiting again, especially in this ASU. There's new guidance on what could and what could not be allocated from a management in general. So there's new guidance on there. Again, this is for consistency purposes, where some non-for-profits were doing it that way, some weren't. And again, this ASU is really trying to make everybody kind of report the same way. So that there are changes in there. It's something to do with the direct conduct or the direct supervision of the M&G type personnel. But there are wording changes in the ASU that could affect what you could and not could allocate from management in general. Okay. And as Mike said, it's going to require additional qualitative disclosures about the methods. A standard kind of approach will not be good enough anymore. You need to have a qualitative disclosure about how those expenses are allocated, like what methods are used, if it's square footage, it's FTEs. That would have to be a little bit more elaborate. This ASU is requiring that there be a little bit more disclosure on how those things actually get allocated. Continuing right along, here's an example of one, as I just mentioned, of a disclosure that would be in your accounting policies. Good, and thank you. And this kind of information would need to be required going forward, but it really wasn't before this ASU was out there. Okay.
So let's just talk about one thing. I told John we got to speed it up.
Yes.
We got more stuff to do, but
We got a lot to cover.
I end up slowing them down. So I'm like
No
I'm like the Russian winter. So
It's a joint effort.
but let's talk about this, because anybody who has their slides here is going to see on the web and in person here a square footage basis for depreciation and amortization. Obviously, you would directly allocate depreciation to specifically identified equipment. So just write that in as a note. So I don't see anybody ever using square footage on something like that. That was my only note there. And I just, again, want to reiterate down here in the very bottom paragraph, information is supplementary. This information cannot be supplementary. No. That can't happen anymore, okay?
Good. All right, moving along. If you have questions, please write them down. We'll be glad to cover them later or after. That'll be fine. Okay, investment return for the gentleman in the back and for everybody else. This is how to present it and what to disclose. Investment return, again, because of inconsistencies, the FASB felt that there should be a little bit more. Some not-for-profits hire an outside management company to manage their portfolio investments, and some do not. It might be internally managed. There might be a board that's helping manage that, and FASB, really felt that that's an inconsistency, because you're allowed to net the investment return. The investment expenses against the return. So if you're internally doing it, there's nothing to net, because you can't. Before this ASU, you couldn't net it. You netted external investment expenses. This ASU is saying, well, if you have direct internal investment expenses, your CFO is spending 10 to 15, 20% of his time managing the portfolio, allocate that to the investment return, and that gets netted. That's a very interesting concept that was never there before. So if you're internally managing your portfolio and you're not paying an investment manager, or you're paying an investment manager and you're kind of doing it also, you're allowed now to net that cost. You have to allocate the cost of the person who's doing it. Let's say you have a chief investment officer, right? If that's all they do, then that salary gets netted, right, against the investment return. They want non-for-profits to show their investment return consistently from one to another so that they can compare on a comparable basis.
But again, you can still come up with that subtotal and then just do a below-the-line adjustment so you still get to the same place. We have some tax gurus talking later this afternoon. I think Magdalena and Rob are somewhere around. I can't see too well from a distance. But hi, Magdalena. So they're going to be talking a little bit about some tax stuff. I don't know what the answer is on the 990. There will probably be another reconciling item on the 990 because the 990 is going to show payroll, right? And the CIO, Chief Investment Officer, is going to be in there. And it might be netted in the GAAP-based financial statements. So it'll be another one of those kinds of things.
The interesting thing about this ASU is you're no longer going to be required to disclose your components of your investment return. Also, I'm not sure if that's really on here, but your investment expenses do not need to be separately disclosed unless you are allocating internal investment costs to your investment return. That's the only thing that would need to be actually disclosed. But the components of the investment return, as it says there on the last bullet on the bottom, will no longer need that. That means you don't have to have your footnote in investment saying, here's how much interest and dividends, unrealized and realized gains, total investment return. No longer required. But of course, if you want it there, it's perfectly okay to be there. That's just something that FASB just threw in there. You don't need investment return. All right, let's continue right along. Cash flow statements is the other example. The top part there is the direct method and the indirect method. If you are going to use the direct method, the ASU, to encourage non-for-profits to actually use the direct method, they're encouraging, if you want to do it, you don't have to have the reconciliation between the indirect and the direct. Just show the direct and you're fine.
And we're going to go over this just as quickly as I would in a post-audit presentation. So I actually do like this. I mean, I like this. This tells the story here of what's going on over here, right? But it tells it in a different way. Right. Looking at changes in balance sheet accounts is like kind of confusing to a lot of people. Okay, I can do the math, but it doesn't tell me what's really going on. But this really tells me exactly what my operations did, either positively or negatively towards my cash. I mean, I like this. The more I look at this, the more I like it. But, they're your financials, so you probably still want to do it the old way, which is fine. But you still get the same answer. I just don't see the meaningfulness of a change in an asset and liability year over year. So that's about as much time we're going to spend on this one.
Okay, good. I was going to say my part, but it gets to the same bottom numbers there, as you can see, of course. But it tells you something. The subtotals, in my opinion, Mike, the subtotals mean a lot. Are their operations, let's say the indirect method, are they really generating cash from their operations or not? So that subtotal is what I focus on.
No doubt, but you have to explain this concept in here of changes year over year. So your receivables are booked as income up top in your operating surplus, but they didn't get collected, so the change in the receivable portfolio is down.
And exactly, so, that's kind of why I like it, because you can easily point out that somehow your receivable lower. That means the city is not paying you as fast as it should be, which probably is the case, or you're not doing a good job on collecting your receivables.
That's why you're the smart guy.
No. All right. There's two ways. Both approaches are good, and I'm glad that FASB said you can show both. That was actually one of the first things that they backed off on, as you know that. They said they wanted it done, and that was the first thing they said, we're not going to push it. So I was happy about that. All right. Good. All right. Once you have to implement this, you should have in your accounting policies a change in accounting policy. This really is significant enough that you would have to have and tell the outside world that you adopted this and this is what's happening. And auditors, and I know in our firm, we're going to have to probably have that in our opinions also. That this is like as another matter saying in fiscal year 2018, the XYZ organization adopted this policy. I think it's that strong, and I know Mike, you felt the same 100%. Way. It's that strong that this needs to be said in your financial statements, and your auditors should have that in there.
It's still an unmodified report.
Right, unmodified, but it's another matter. It's telling the world that hey, things changed from the past to now, and a footnote explaining all this. And there's a nice good example right there. Okay, and especially if you had any kind of reclasses because of this. Like the endowments from unrestricted to the underwater endowments from net assets without donor restrictions to with donor restrictions, that's a reclass. That kind of has it spelled out right here, which is a very good example right there. So this is going to make you have to reclass something that you previously had shown another way. That should be spelled out in your financials.
Okay, so I think we're done with this particular topic. We're going to hit the next couple of topics a little bit quicker.
Yes.
But I want to ask something. Please don't be embarrassed to raise your hand. How many have already gone through the exercise of mocking up a financial statement that's going to look like the new standard? I got one hand.
All right.
I got two. I got three. I got four. Do I have any more?
All right.
All right. Very small percentage. I expected that. I was hoping maybe 10 or more. Probably everybody on the web, just so you know, they're all in. They probably all raise their hands, okay? So I don't want to make you feel bad.
That's why they didn't come personally. No.
We're just not seeing it yet. It's like everything else, you know, people just wait. They wait, they procrastinate. I get it. So, but hopefully you're going to start that now because it's calendar 18. Okay.
Good. All right. The next area is what Mike and I was talking about. This new accounting standard issued again this last summer on clarifying how contributions received and made. This clarifies the old FAS 116 that came out back in the early 90s on what a contribution is. And it has a big impact, as Mike said, on government grants being, kind of left out of what is it? Is it, an exchange transaction or not? So I will try to go over this a little quickly, but it is a little bit more complicated area here. That's a complicated slide that we have up here right now, but this shows why this is needed. It's needed because of, again, consistency. There was inconsistency in practice of how government grants were being treated. Think about it. You get a government grant to provide child care services, to provide people getting back to work, a job placement service, or you're doing something like that for the government. You're getting a New York City, New York State contract to do that, help people get back to work or provide child care services. The FASB is saying the government is not directly receiving any benefit in exchange for that grant they're giving you, right? So some not-for-profits would consider that an exchange transaction because I'm doing something, the government is paying me, right? I have to do it before I get paid. FASB is saying, no, that's really not really how it works. It's not an exchange transaction because the government is not getting anything in return. That's a very kind of different concept than how it was. They're basically saying there, you can see on the bottom, the government is not synonymous with the general public. The general public is benefiting from that grant, getting people back to work, providing child care so the single parent can go back to work. That concept that the government is getting something in value of an exchange, let's go over that first, I guess what it is. On this, it says issue 1, reciprocal or non-reciprocal. Reciprocal means both parties are getting something of equal value. The government is paying you for something, you're providing the service, they're getting something of equal value. They're saying again, if it's benefiting the general public, society, they're not getting equal value. So that's really now can be considered a contribution. So that's very interesting. All your government grants are now going to fall under the contribution guidance in the accounting and not the accounting standards for exchange transactions, which fall under the revenue recognition standards.
Okay, so let me put a human touch to this again. You'll get to it later. We probably should have put it up front. Slide 35, don't turn to it. But slide 35 says when you got to do this. You got it if you're a non-issuer of, say, public debt, you're not issuing bonds, so you're considered an other entity, calendar 2019 or fiscal 2020. So we got a little time on this one. If you are an issuer of conduit debt, public debt, bonds,
like
DASNY,
colleges,
whatever,
universities,
that kind of stuff, you got to do it for calendar 19. They lined it up the same as all other entities because they realized they only issued this in 2018 because they realized they needed a patch against the old RevRec standard that was around for a couple of years that had an implementation date of the future. And on fiscal year ends, since some of you in here are fiscals, fiscal 19 would be on the public side. So if you have bonds, keep in mind you got about a year earlier. The other thing I'm going to do, because I want to go fast through this stuff, because the slides are kind of complicated. You can read them on your own. I'm going to tell you right now, this was the FASB's patch. They said, we issued RevRec, we scoped out contributions. What about government grants? A lot of government grants are shown on not-for-profit financial statements as exchange transaction, meaning getting commensurate value. Why? The theory behind that was the government was acting for the public good, and then the not-for-profit, don't take this word agent wrong in terms of an agency transaction, but the not-for-profit was nothing but a conduit or an agent to help that public good get achieved. So therefore, it became a commensurate value, equal exchange, whereas non-reciprocal, which is the contributions, John says, you're getting nothing back. Mike McNee gives PCDC $100,000 pledge. I don't want anything back for it. What's that? It's a non-reciprocal transaction.
Record that.
That's not a bona fide pledge.
Oh, it's on tape.
But
you have evidence?
In any event, so that's what I want to get down to. See, what you're going to see now is you're going to see, it's interesting, you would say, oh, so we've always shown our government grants in the unrestricted column, exchange transaction, right? We didn't have the release and all the rest of that stuff that goes on with contributions. You're still going to be allowed to do that because they realize that if you do take care of your expenditures in the same way you did in the past, effectively they're going to allow you to do that simultaneous release. That comes up in a later slide, but I want you to recognize that. It's not that your financials generally are not going to look all that different if you're following some of these guidelines, if you have the types of revenue that I think probably 90% of the audience does. Yes. No questions from Mark's panel. You're too smart. No. Sorry, Hope. What's up?
I think what's frightening to a lot of organizations is assigning government money as a contribution. So I think it's just the name.
Right. So let me repeat the question. So Hope Goldstein, my esteemed co-lead of the not-for-profit group, says what's scary to her and probably to a lot of other people is how can you put nomenclature of a government grant being a contribution? I don't disagree with it, but guess what? You can still call it government grants.
Call government grants.
Yeah, so in your statement of activities, nothing changes.
Good point.
Fees for service from Medicaid, government grants, whatever you want to do, and you can still show them in the without donor restriction column if you take care of business in the same year.
It's just how the accounting, what the accounting would have to follow.
The
name is the same. Your government grants is government grants.
It's a patch.
Right.
They forgot. They got government grants into it.
Good. Let's continue. As Mike was saying, we don't want to run you later than what we should, and we still got some time, a little bit. To make this all work, FASB had to kind of change their definitions of what a conditional contribution is. So basically, they're saying that a government grant falls under these rules of conditional contribution if it has a right of return or a release and a barrier, right of return or release from the grantor. These are barriers that have to be overcome. So they literally changed the definition of what a conditional contribution is to make it fit. They went into the codification, literally crossed off the old meaning of a conditional contribution, which has been eliminated, and rewrote it that it has to have a right of return or a release from the obligation and some kind of barrier that needs to be overcome. That word barrier to overcome was never in the wording for a conditional contribution. So that barrier to overcome is providing the service. You get a government grant to provide child care services, that is your barrier. It's conditional until you provide the service. Once you've provided the service, it's now unconditional, can be recorded. As you probably know, conditional contributions are not recorded. So you don't record it if you get a government grant and didn't do anything with it. Don't just go out and say, Mark's Panis said their contributions, the minute I get it, I'm going to record it. No. The way to make it work, it's conditional contribution until you actually met those conditions. Once you met the conditions, then it's unconditional, and then it gets recorded.
All right, we got 9 minutes. I'm going to speed it up. What I'm going to tell you is, again, I like to try to just hit the high levels of this thing. What makes this interesting is the fact that since the FASB is pushing everybody towards characterizing government grants as contributions, guess what? The old rules of disclosure of conditional contributions are in play.
Yes.
Which means you got to figure out how long is that contract, whether it's renewable, and so on and so forth. And you got to put certain disclosures in your financials surrounding government grants in the future you never had to do before. Why? Because generally most people treated them as exchange transactions.
That's very important. I was going to get that
really,
next.
really big deal. So you got to pay a lot of attention to the note disclosure on this.
Conditional, I have a slide on conditional contributions and what needs to be disclosed. Unconditional, of course, you record it. Conditional ones you need to disclose. This is a very good slide. This kind of goes off the path on this one a little bit, but this tells you what really kind of hits the point on a lot of things. On the left here is if it's a reciprocal exchange transaction, that you follow not this standard, you follow the revenue recognition standards. That's back in 2014-09. because each party is getting something, even if it's the government. Now remember, the government is not getting something on a lot of the government grants that you're receiving, unless you're doing a study for them. Imagine if the New York State says, I need a study on homeless populations in New York City, and they give you the grant to do that. You give that results of that study back to that New York State agency, that they're getting something in exchange. That's not a contribution. That's an exchange, and you follow the revenue recognition standards. But if again, it says, here's a grant to provide homeless services, contribution. And it's a non-reciprocal. Both parties are not getting something. And you follow this ASU 2018-08. Because then you have to follow as a conditional. Once it's conditional, it has to meet all these kind of criteria, has a right of return, has a barrier. If that's the case, that's a conditional contribution. If it doesn't have those, it's unconditional, and it'll be recorded like any other contribution, and it could be with or without donor restrictions.
So John, is a barrier something like recording or representing to the government what your quarterly expenditures were towards a grant? Is that a barrier?
I kind of don't think so. It's actually providing the
I
actual
100%
service.
think not.
Good.
Okay, it's an administrative thing.
Administrators
That's all
don't really
it is.
count as a barrier. It's actually providing what the grant is for. If you're doing, dealing with, a certain population, you have to do that. You actually have to do it. The administrative requirements don't really fall into this.
Yeah.
Good point. Okay, let's move up a little quickly. This is a little bit more about reciprocal, non-reciprocal. We kind of covered all that. In the current, like I said, the general public was considered an exchange. That's not true. As you can see here, clarification, the general public, non-exchange. Right? Key thing on that slide right there, that's very important. That's FASB's doing. That's how they felt. All right? This is a little bit about unconditional and conditional contributions. Again, the new ASU, only need to look at what's on the left here, has to have some kind of right of return or a barrier. And there's examples of some barriers right here. Again, a barrier is something that you would have to overcome to earn the money, right? Think of it that way. You get a government grant, usually you have to do something, right? It's not usually not a gift, right? Only contributions, only gifts, you don't have to do anything. You don't have to overcome. If there's something you would have to do to really earn it, that's what that really means by the barrier basically in plain English.
And just to decouple fees for service from this discussion, because fees for service are not grants. The fee for service revenue recognition follows the 2014 ASU, but I don't think that's going to be a big deal for most places either, because you were only recording the income based on meeting the obligations of the contractual arrangement you had with Medicaid or whomever it was. Okay.
Fee for service, as Mike's saying, is really an exchange transaction. I provided the service, I get the fee, right? That doesn't fall under this as a contribution.
John, I think we got some nice examples in here.
Good,
Can we
right?
just skip to 27?
Good. Okay, there it is.
All right.
You want me to go over it?
No,
or-
yeah, just hit it.
Okay. These are some examples of what indicators are. This is a measurable barrier. That they're providing career training services to disabled veterans. That's a great, nice cause, right? Get disabled veterans back to work, right? The grant says you provide trainings for at least 8,000 disabled veterans during the next year, and they have targets of what you need to do for each quarter. That's really, it sounds like a real government grant that you had to do something. Those are now the barriers. Is the government actually getting anything in return in this case? No, right? Who's getting the benefit? Disabled veterans, right? So it's considered a contribution because each party is not getting something of equal value. The government helping disabled veterans is a great notable cause, but that government entity is not getting anything in return. So this falls under that ASU as a contribution.
So the real question is, just to continue to speed this up a little bit, you all got the answer. It's on the next slide.
Good, yeah, next slide has the answer.
I kind of wish we didn't have the answer because I'd like to see the audience's reaction, but I assume everybody views this as conditional, right?
Right, so once
You
you've
got
actually
those
provided the
target
services, it's now unconditional and gets recorded. The minute you actually receive the grant and didn't provide any services, you have to have it as conditional contribution, no dollar amounts recorded, but if your financial statements were going to be issued, you would have to actually show that you have a conditional contribution, but no dollar amounts are recorded.
Right, so the interesting thing about this is we go back to the mid-90s when FAS 116 came out. I'm old enough to have had darts thrown at me by board members when I had to explain to them that the matching principle that we all went to school with didn't exist anymore.
I'm glad that didn't happen to me.
If you got a contribution in that was restricted for some, you had to pick it up as income. It fell into a different column, but you still picked it up as income. Everybody's like, what are you kidding? We didn't make $2 million. So what this does is, it's interesting. It takes, say, foundation grants that do have that barrier, and all of a sudden it kind of goes back. It pulls it back, the income, away from having to recognize it as temporary restricted, and it pulls it into just a disclosure-only item. So that's kind of neat. I mean, I think that's happening somewhat now, but it's going to happen much more with that. All right, so we know that one's conditional. We've overkilled that
I'd like to move on to number 30. I think that was a good example to save time. I'm on page 30 for you guys online and here in the audience. This sounds like it's a government grant, federal grant, directly from the feds or passed through from a city or state agency. It's a good example. The grant says you need to follow the guidelines by OMB, the U.S. Office of Management and Budget. You have to incur costs and be in compliance with their regulations. It's like a regular federal grant that's probably subject to a single audit. It says any unused funds or any unused assets are forfeited, unallowed, could be refunded. The university retains the right to the finding. So the question is it non-exchange or is it conditional or unconditional? As you can see, there could be confusion here. Again, it says the university is to do what? The university awarded a grant to, it's not really kind of spelling that out right.
Well, it's got to spend money in accordance with OMB guidelines.
Spend the money in accordance.
So again, this one, I don't think you're going to account for any differently than you are already. You're not picking up income that you didn't spend yet, right?
Right.
So you're doing a discrete P&L in all of your grants, and if you didn't spend the money according to contractual obligations, you don't pick it up as income. Under the exchange accounting rules, because you didn't earn it, if you got it in advance, I bet you not too many people get government money in advance, do you? Nah, I didn't think so. But for those that might get government money in advance, I think it would show up as due to governmental agencies, right? So okay.
This was for the research, and the research, it's still conditional. This would still fall under this ASU. This would still be considered that, even though it's like a federal grant that you would think that's subject to a single audit, the accounting for it would still follow this ASU. That's very interesting. All right.
Right.
Very different and very interesting. It's not really an exchange transaction.
Say, John, can you go to 33?
Sure, let's
We've already talked about it, but let's put it down in writing.
This is an important concept too.
This is the simultaneous release concept that I had spoken about earlier. So we're talking about current gap. It's in one bucket, no big deal there. Forthcoming would be that option to stick it into without donor restriction column if you spend it in the same period.
Can I help explain what this is all about a little bit? Simultaneous release is when you met the restriction in the same period as you got the restricted gift. It's allowed under not-for-profit accounting rules that if that happens, you could have a policy that you have a simultaneous release, it gets recorded as unrestricted or now without donor restrictions. So those rules did not change with this ASU or even the other ASU. So that's still allowed to do that. But the difference now is because you have conditional and unconditional, so you might have simultaneous releases that came from restricted conditionals or restricted than other, meaning other type restrictions that you met. So they come from two different buckets. So this is what this slide is trying to spell out.
So John, I'm going to take the liberty of being the leader here.
Yes.
And I'm going to talk for the next 1.5 minutes.
Cool, go ahead. That's
So
all we have left.
what I'm going to tell you is you go to slide 34. 34 is important. Just go to that one slide.
Sure.
That'll kind of end us off on this topic. 34 is one of some pretty important stuff. You didn't have to disclose this stuff on government grants in the past. Now you got to go ahead and do this. So you've got to figure out what they're giving you, what are multi-year type grants, and you're going to be considering those probably conditional. So you got to do all those disclosures. So this is a pretty important tab, and for those that are watching on television, tab 34 is really important. The years that you have to do this are on 35. Leases. Very, very quickly. As is usual, they get deferred by a year for non-public. This is slide 37. We've been hearing about leases for 1 million years, okay? Basically, the concept is simple. You should be looking at your leases now, both real property and equipment. You should always look at these things anyways for cancelability clauses, because you have commitment note disclosure and all sorts of things along those lines. Capital leases exist, bargain purchase options and 75% of useful life, all that kind of stuff. So you should always be looking at those anyways, but you got to pull, well, just wait 1 minute. You've got to pull all of those leases out and look at them. And some organizations have a lot of leases. So even though this is off in the distance, I would suggest you start on this process now. It's going to have no impact on your P&L. None. Zero. Okay, all we're going to do is pick up the present value of the right to use the asset in the future, and the present value would be discounted generally by a risk-free rate of return. You have other options, but that's probably the one that people find most expedient. And the liability is what we're going to have to pay the landlord at its present value. They match each other. You still do the same straight lining of expenses on the rent and the P&L. Everything's all the same, except one thing, your balance sheet's off. And interestingly enough, I know we have a couple bankers, at least they signed up, I'm not sure they're here. I think the bankers generally get it, but I've talked to a couple bankers, and they really didn't look and talk to their not-for-profits as to whether they have to restate some of the covenants that they have to live by under their lines of credit or other things that they have. So I think that is probably, even though I'm not spending much time on the leases, that's about as much time as we have. I think the important thing was to have spent the most time on the financial statement implementation, less time on the new ASU patch, I call it, on the conditional, unconditional, and grant activity versus exchange. I know we had a question in the back. We have about 30 seconds.
Yeah, I'll use that. I do appreciate the new FASB standards on the net asset classification, contributions, exchange, transaction, conditional, and unconditional, but I really do not understand why we need to inflate the asset for the right to use a property during the lease period and then present as a wash, as a liability. What's the objective of this new FASB?
Well, that's a great question. I might ask the same question, and I think that's why it was debated for 8 years or something. We know right now you have an obligation to show a commitment note, right? What you're going to have to pay out to the landlord over the next X number of years. I think the FASB felt for better transparency, even though, again, it's kind of meaningless on a lot of levels. It does show the true economic discourse of what's happening. You have a right to use that asset. The landlord's held to it through a legal document. Unless there's a cancelability clause, then you wouldn't even book it in the first place if it's considered a short-term lease. And you also have an obligation to pay the landlord, which you've always shown in your commitment note, not at present value, but at full cash value. So I agree with you on all sorts of levels. It makes the balance sheet much more cumbersome than it ever was. And I must tell you, when the straight lining rules came out, really a long time ago, I think I was still in grade school back then. But when we went to clients that weren't doing straight lining, we found prior period adjustments that were very large. They were like, when did these rules come out? I go, well, I think I was in 4th grade when it came out. But irrespective of that, now I got to book a straight lining adjustment. And what meaning does that have? That's not my cash outflow. I got to smooth out the impact of rising rents over the next 10 years. And we have clients where they specifically wanted that adjustment stuck in the non-operating section of the P&L. So I agree. Everything's not always perfect. Sometimes things get cumbersome, and the rules are the rules.
Can I add on that? I think FASB really wanted, man, they really showed that liability that was never on the balance sheets. It was in a footnote. That liability of your leases. A lot of not-for-profits lease, facilities, and that liability was never there. And the only to make it work, you had to show that liability and the asset.
Well, sorry about that, but Joe's going to give you the hook, so we're done. Thank you guys. Time. There's a lot of material to cover here.